So what is a remortgage? Well, in this video, I'm going to be taking you through the basics of what remortgages are and what you should be considering. Hi, this is Sam at Rosehill Financial Services. We're specialists in mortgages for the self-employed. If this is your first time watching, I hope you do find our content useful, and please do share with anyone who may benefit from watching these videos too. So first of all, a mortgage is a loan from a bank or a building society that helps people buy property. So if you haven't already watched our video on what a mortgage is, I recommend you watch that first. A remortgage is essentially where you replace your existing mortgage with your existing lender with a new mortgage from a new lender. So you might be thinking, why would I need to replace my existing mortgage? So we're going to run through a couple of scenarios now which you may find yourselves in. So the first scenario is that you've fixed in with your current lender for say 2 years and you're coming to the end of that fixed rate. So what will generally happen is that you will fall onto the lender's standard variable rate, which is usually a fair bit higher than the current interest rate that you might have. So to avoid falling onto the standard variable rate, you can look to remortgage, and we recommend looking in advance. So with our clients, we would contact up to 6 months in advance to start the process of the remortgage, so that none of our clients actually fall onto this higher rate and end up paying more than they need to. The second scenario is if your current interest rate is already high. So this may be if you're already sitting on the standard variable rate, or you actually fixed in when mortgage rates were particularly high compared to what's available now. If you're already on the standard variable rate, then you may find that you can save money very quickly by either choosing a new product with your existing lender or remortgaging to a new lender. If you are fixed in with your current lender, but the rate is much higher than what seems to be available now, then it might be worth considering remortgaging, even if that means paying some early repayment charges. So you'll want to look at all costs involved. So generally you'll find that there's arrangement fees when you look to remortgage with other lenders, and this should be compared to any early repayments that you have or exit fees with your existing lender, along with the monthly payments of both products. If you've got a good broker working with you, they should be able to work these figures out for you. Another scenario could be if you're looking to borrow more money. So this could be for home improvements or for debt consolidation or whichever it might be. Now you can potentially do this with your existing lender, which would be known as a further advance. But if you don't fit the criteria for that additional lending, then a remortgage may be the most suitable option for you. Now you would be expected to give details of what the additional funds are for. So if it's for home improvements, for example, the lender may ask for buildings quotes to back up the reasoning for the additional funds. The fourth scenario is if your property has increased in value quite substantially, as you may find that you can benefit from a more favourable interest rate. Now, one of the deciding factors in determining your interest rate will actually be your loan to value. Now, your loan to value will be a percentage which is your value of the mortgage debt in relation to the property value. So for example, if you had a property worth £400,000 and your mortgage on that was £300,000, then your loan to value would be 75%. So it's basically the opposite of what your deposit or equity would be. Now generally, mortgage interest rates will be more favourable at each 5% increment in the interest rates. So if you initially applied at 85%, so say if you bought with a 15% deposit, and your property is increased in value to bring that loan to value down to 75%, you may benefit from a lower interest rate. Now again, it's best to weigh up all costs involved, particularly if you are fixed in with your current mortgage, because the early repayment charges might outweigh the savings that you make on the new interest rate. And finally, the last scenario that we want to go over is if you want to change the terms of your mortgage. So for example, you may want to change your repayment mortgage onto an interest-only mortgage, or you may want to change to a lender that has no early repayment charges. Say for example, in your new job, if you received a lot of income from bonuses, you may want to use that as lump sums to pay off your mortgage, which may incur early repayment charges with your current lender. So if you want more flexibility or want to change your repayment method, then it may be best for you to switch lenders. So are there any reasons why I shouldn't remortgage? Well, firstly, you're going to want to check the full details of your current mortgage. So if you request what's called a mortgage redemption statement from your current lender, this document should provide you with all details regarding your early repayment charges, if there are any, and any mortgage exit fees. This way it's easier to work out whether it's worth switching to a new lender, particularly if you are still fixed in with your current mortgage. So secondly, I wouldn't only base your decision on the interest rate with other lenders. I'd look at all costs involved. So say for example, your existing lender had an interest rate that you could switch to, which is slightly higher than what's available on the market, but they don't charge any arrangement fees, then this could work out to be more cost effective for you. The other lenders, although they may have lower interest rates to entice you into that deal, they may charge between £1,000 or £1,500 in arrangement fees. If you've got a good broker working with you, they will be able to source the market on a total to pay or total cost basis to take into account all costs involved for you. And lastly, it's worth checking full affordability before you look to apply for a remortgage. So if you've had changes in circumstances, say if you've had a child, any sort of adverse credit, then this may impact your chances of being able to remortgage to a new lender. In these scenarios, it may be more suitable to just switch the rate with your existing lender, as there's no affordability checks. It's also worth checking with local estate agents for the current value of your property, because in the unfortunate scenario that the value is actually lower than when you first bought the property, you may find that you can't get the interest rates that you were initially looking at. So just as an overview of what we've discussed today, a remortgage is essentially replacing your existing mortgage with your current lender with a new mortgage from a new lender. Secondly, you could save a good amount of money by remortgaging, particularly if you're sitting on that standard variable rate with your current lender. Thirdly, if you are fixed in with your current lender, it's worth checking in advance what the remortgage options are. So you can do this anywhere between sort of 3 and 6 months, just to allow enough time to prep your remortgage. Next up, consider using a mortgage broker, as they will be able to assess your full affordability and advise on the most suitable product to your circumstances. They'll also be able to source many lenders all at once, and they'll know the criteria inside out. So it will save you a lot of time when you are looking to remortgage. So I'd love to hear from you. Are you looking to remortgage, and have you had any struggles in doing so? Please do let me know. If you'd like any further information at all, please don't hesitate to drop me a comment and I'll be happy to help. I hope you've enjoyed this video, and I look forward to bringing you more useful content in the near future, and I'll see you in the next one.